Hey traders, this is Blake Morrow. With me today is Marc Chandler from Bannockburn Forex, and I'm so happy to have you here, especially after this historic week of central bank shenanigans. We had a lot of movement this week, obviously, and we still have one more central bank to go. But it's nice to have you here, Marc.
It's always a pleasure to see you.
Well, it is really nice to see you, and I'm really excited about hearing your point of view on what happened this last week. I mean, we got obviously a very negative reaction in equities. We saw the euro briefly push below 106, but it seems like the dollar is struggling to make some decent gains, even with stocks as weak as they are. What's your instant reaction to what you saw out of the FOMC, the Bank of England, the European Central Bank, and anything else that you might want to note?
Yeah, sure. So I think I'll maybe begin off with the Fed, because that's of course the sort of linchpin in the whole system. I think in many ways still. So in many ways, the day that the Fed met, my daily comment was titled like, "What could the Fed tell us that we don't already know?" And that's what I really came away with. That at the end of the day, despite the equity volatility, short-term U.S. interest rates hardly changed. The market knew more or less what the Fed was going to do. Hike 50 basis points, raise what they now say is the terminal rate to 5.1%, which was just a little bit above the market. I felt confident they couldn't go below the market. So they had to either match the market or go a little bit above it. They went a little bit above it. But at the end of the day, we've all known this. I mean, you can see this in the June Fed funds futures. They've been trading, say, 12 or so basis points around the 5% handle for some time now. And I think that's really the key to the dollar. Most of this year, I think that the dollar's rally was as the market kept adjusting to a higher and higher terminal rate. But as the market now has stabilized, say, give or take 5%, the dollar has clearly come off of the boil, so to speak. And when I notice a change in what's going on in the market, it would be something like this. Until maybe early October, the market was happy to buy dollar dips. And now I think it's more happy, or more likely or more impulsive, if you will, to sell dollar rallies than buy dips.
Yeah.
So I do think the dollar's turned. I think that I think that a lot of, I want to say there's a cottage industry out there that likes to play up the drama at the Fed between the bulls and between the doves and the hawks and what. And I think it's like, I don't think it's particularly helpful. I think that the FOMC decision was clear. Something like 17 out of the 19 officials had Fed funds peaking at 5% or a little bit above. So it seems to me that out of the different central banks, the Federal Reserve seems to be a pretty uniform pack so far. And this, I think it might change as we get closer to the end of their hiking. But I think that the real tension, if you will, is between the Federal Reserve that says they're going to keep hiking and that they don't plan on cutting. In fact, Powell said he can't even think about cutting. Can't even talk about cutting rates. But the market, so I'm looking at, and I think we talked about this before, early in our careers, we would look at the Eurodollar futures, but the more accurate futures right now is the Fed funds futures. And it's the largest, what's amazing, it's the largest notional futures contract, notional value, $5 million, while the Eurodollar futures are $1 million only. It's the notional value. So, of course, the Fed funds don't have the same volume, but you got to multiply it by 5 to get the Eurodollar like equivalent.
Yeah.
And I'm looking at the difference between the September contract next year and the December contract. The market has been pretty consistent, looking for a rate cut at the end of next year, despite the Fed's pushbacks. And so I think that besides the terminal rate, I think that's the other thing to keep an eye on is this expectations of a cut.
Yeah. So I was gonna ask really quick, do you fall into that camp where you think that the Fed's actually going to do it? I mean, or do you feel that the Fed chairman's been pretty steady with his hand and he might actually end up keeping rates elevated unless we see, inflation and maybe the jobs market really turn and we see the inflation CPI back down in the 2% handle. I mean, what are your thoughts there?
Yeah, so I think you're right that the Fed has been very clear. They don't want to cut. They want to leave rates high for longer than the market anticipates. I'm sort of leaning, though, towards that rate cut. I do think that the economy is weaker And there's a lot of different ways to think about the economy. I'd say let's not talk about GDP itself. It's backward looking. It's really an aggregate. What we want to look at are sort of some leading indicators like new orders drying up. Whether you look at any of the Fed surveys, the PMI, new orders is drying up.
Yeah.
Secondly, I think the U.S. consumer, it's funny, I was reading an FT op-ed piece and it talked about how savings rate is holding up. I don't see how we can talk about savings rate in the abstract and the general level without talking about the distribution. And that is to say that, to me, I know when the financial pages are telling us that inflation is the number one problem in America. I don't think so. I think that ultimately the disparity of wealth and income is a bigger problem in the U.S. And I think that's going to come and haunt us when we talk about sustaining consumption. We're already seeing cracks, consumer credit slowing down. A cash register for many households was refinancing earlier in the cycle and pulling out cash. That's dried up. Savings rate for middle-class Americans and lower is falling. And so I think the consumer, which is really the key driver of the economy, is tapped out. And wages, despite this idea that wages are rising at the cause of inflation, and Powell talked about this as a tightness of the labor market, I don't buy it. I think, yeah, wages are rising, partly because people are shifting to more productive jobs. Secondly, it's rising, but it's not keeping pace with inflation. So we still have a cost of living squeeze in America, and I think that drags down the economy. Perhaps not right away. It's the U.S. economy is like the QE2. It takes a while for it to turn around, and but I do think that the forces are already set in motion, and I think it's going to be hard to avoid it. And even if you look at like some of these monetary variables like yield curves, of course, everybody follows the 2 to 10, and we know that's deeply inverted. Powell has pushed against that and talked about the 3-month forward in 18 months. 3-month yield, 18 months forward against the 3-month yield, that is inverted. He earlier in the cycle said this was a sign of recession. And so I'm sort of more in that camp. And I think that one of the things that has weighed on the dollar is that other central banks have become more aggressive. And I think you see that really with the ECB. Yeah. The Federal Reserve leaves open the possibility, and I think the market's there already, that the next hikes in early 2023 will be 25 basis points. Lagarde and now some of the other senior officials have done everything but guarantee another 50 basis point hike and perhaps another one after that. And when you think about dissent and the challenge of central banks, I say don't pay attention to this dove-hawk divide the Fed quite yet. But the Bank of England, you saw a 3-way split. A couple wanted to leave rates completely on hold, and one of them, a man, Catherine Mann, from a great reputation of OECD economist, a great addition to the Bank of England. She's called for a 75 basis point hike last time. And so the majority, the 6 members, voted for 50, and the market hasn't given up the possibility of another 50 basis point hike from the Bank of England early next year. So it sort of leaves, in some ways, you've got this maybe like a big like S cycle, a big S curve. You've got some central banks like Australia, Canada, which seem to be nearly done. You've got the Fed that should be done in the first half of next year. And you've got the Bank of England, the ECB, a little further on. More hikes to come.
It's going to be really interesting to watch how the market, the FX market, responds to that, because the more hawkish ECB on Thursday really caught, I think, the market, obviously flat-footed a little bit there. But if the equity markets, start pricing in maybe an earnings contraction, and we start to see the stock market maybe under some pressure the first quarter, yet if people believe the Fed is going to, stay put, and maybe the ECB is going to continue to stay hawkish, that would tend to favor the euro US dollar, tend to favor the euro higher. But if there's some risk aversion, is there going to be a rush back to the dollar this time? And I think that's something that I think that we probably need to watch that first quarter of this next year.
Yeah, I think that the risk aversion, comes from a couple of places. I'm not so concerned about the stock market. I know there's this idea that there's this put, the Fed, the famous Fed put. I think it's really misunderstood. The Fed is not trying to save, and I can't think of a time where the Fed exercises the Fed put, so to speak, and it was just about the stock market. I think that this is not the time to see if the Fed put exists. I think that when the time is when there's systemic risk, like there was 2020, like there was in 2008, 2009, that's the time to really see if there is a Fed put. And I think there is. I think the Fed and other central banks are concerned about systemic threats. The weakening of the stock market right now is not a systemic threat. It might be a systemic threat to us as individual traders and our wherewithal to stay in the game. But I don't think from a financial systems point of view, it's really a systemic threat. Instead, I would think that the systemic threat this time comes from a couple of other places. First is China. What a complete reversal, right? Up until a few weeks ago, China was saying COVID is really scary and deserved a zero COVID policy, this intolerance for COVID. And all of a sudden, they said, COVID's not so bad after all. It's like the flu. And so I think that we're going to get, it's one of those things, there's this famous economist, Joan Robinson, a Keynesian, who said that the only thing worse than being exploited by capitalism is not being exploited by capitalism. And I think that the same thing is true about COVID here in China. The only thing worse than zero COVID is this reversal as far as disruption, fatalities. And so I think that China poses some risk. Emerging markets, commodities, global supply chains, all at risk in a way that, in a similar parallel way as the zero COVID policy was. And the other type of big risk that I'm watching is that central banks now, and the bank and the ECB said the same thing essentially. They're going to begin unwinding their balance sheet purposefully, not just letting these loans mature. The Fed is, the Bank of England is, other central banks unwinding their balance sheet. And we don't know what the appropriate level of reserves that the system really needs, given the new facilities. And I think that we're only going to find it by like bumping into it. And then I think we bump into it like we did in 2018, 2019, when the Fed had to pull back from QT. Yeah. So to me, the systemic risks come from China and from this sort of unexplored territory of shrinking the bank's balance sheets, not knowing how much modern day, like sort of up-to-date bank practices are drawing on those reserves.
That's that is something that I'm going to be thinking about too, especially as we start. It's kind of like the onion, it's peeling away the layers and seeing what's underneath. It's going to be an interesting first quarter. Hey, Mark, I know. First of all, I want to say if you all appreciate what Mark's doing here, make sure you give him a thumbs up, subscribe to the channel. He's here after being kind of out of pocket a little bit for a week, so we're really appreciative of having you back, Mark. But I wanted to ask you one last thing before we go. There were some articles over the weekend about the BOJ. Considering the BOJ is going to be meeting tonight, most people watching this video are going to be watching it after the BOJ had already met. However, there's some talk that there might be some tweaks in the statement, and plus, you've got Kuroda is going to be stepping out this next year in 2023. We're going to have a new BOJ governor, so maybe that might be the time that we start to see some change in monetary policy from the Bank of Japan. But what are your thoughts there on the yen as we move into 2023?
Sure. So I guess the first thing I do is, like yourself, I'm a pattern follower. I look for patterns.
Yeah.
And one of the patterns seems to me that's been fairly consistent is the relationship between dollar yen and the US 10-year yields. And we could talk about like why there's a pattern, but I think that you do the correlation. Again, when you do these correlations, try to play this game from home, you want to do the differences of the yen, the differences of the exchange rate, and the differences of yield rather than just do absolute levels.
Yeah. And
I think that the Bank of Japan's intervention was so successful, not because of the volume that they used, more than $60 billion. I don't think it has to do with that. I think what it had to do with, they just were extremely adept at picking a top to U.S. Treasury yields. And with Treasury yields falling, dollar yen's come off quite sharply. I wouldn't expect the Bank of Japan to do anything now. And I think you're right. There are a lot of people, when I look at some of these surveys for next year, I see two things that stand out. One is that many currency people have picked the yen as their favorite currency, and many in the fixed income markets are picking U.S. Treasuries as a big buy. And I think the two are really opposite sides of the same coin, as you can appreciate. I do think that we've seen the Fed, I think, come close to pivoting as far as getting a terminal rate in place and anticipating it within, say, a few months. I think we've seen China pivot on COVID. I think that it's really the BOJ. I think you're right. Is the next big thing to people be watching as a pivot. Now, I think the trick to it is that it's not just the BOJ governor that's term expires, but his two deputies as well. And so the two deputies' term ends in March. Kuroda's term ends in April, so that means the March meeting is the last one for him. I think that here's the challenge. I think it's not just that. I think many people think, well, Kuroda steps down, the BOJ will review policy, it'll change because he's no longer there. And I think this gives too much of a role to the individual. I think the reason that Japan has not deviated from its extraordinary monetary policy is because they don't believe inflation is sustainable. And you can see this in the Japanese forecast, the Bank of Japan's forecast for inflation. They're going to be looking at the core rate, which excludes for them fresh food. It's very close to 3% now. They think it'll be half of that by the end of next year. And so the reason then that the Bank of Japan is in a tough position, even after Kuroda steps down, is that they're looking at a relatively slow economy, and they expect inflation to come off. And so what do you do in that kind of situation? So the first thing I'd say is I'd be looking at one of the, Kuroda comes from the Ministry of Finance. And I would look for the next Bank of Japan governor to come from the BOJ itself. One of the current deputies or a former deputy, most likely to take over the helm. Now, the Reuters article you refer to is really a reference to this document that Prime Minister Abe and Kuroda basically articulated a decade ago. And it made it seem like the 2% inflation target had to be done as soon as possible. So the first step is to walk that back. And there was a denial that it's already been done. But if you look at the wording of the denial, it says that we haven't decided anything yet. It doesn't really mean they haven't, or they won't decide something in the future. And it does seem to me most likely that they do tone that down so that more in line with other central banks, recognizing the inflation target as a medium-term goal or a long-term goal. The other issue, I think, has to do with what they do about their policy. Right now, Japan still has negative short-term interest rates, minus 10 basis points, and they've got a cap on the 10-year bond yield at about 25 basis points. Now, the Bank of Japan owns roughly half of all the JGBs out there. They own, it's funny, if you look at the numbers, they make it sound like the Bank of Japan owns more than 100% of the 10-year. And that's partly because they lend them back to the market and then they buy them back again from the market. And so it gives them this accounting function, but something's got to give. And it does seem to me that something will give probably in the second quarter, third quarter of next year, where they could do a couple of things. One is they could just bring forward that yield curve control, as the IMF has suggested, something to the shorter term, say a 5-year or a 3-year. Yeah. But when you look at this so-called financial oppression, I'd say look at part of the long end of the curve that the Bank of Japan's not directly controlling. You're still looking at very low yields, 120, 130 for the 20-year or the 30-year bond yield. So I think that this is it's not completely artificial. I think people see the same thing: slow growth, slow inflation, and that I should say is really one of my key points that I think that has been it's definitely not in favor now. Everybody's talking about either stagflation scenario or high inflation and why the end of globalization is going to keep up prices. But I think in my work, I should say, I think there's a good chance that not so much next year, 2023, I see that as more of a transitional year, but that old great moderation comes back, where the challenge for large industrial economies is slow growth and low inflation. Like we had before COVID, before the war in Ukraine. I think we go back to that great moderation, and that becomes the bigger policy challenge. I think the same thing about this, what Powell says is this tightness of the labor market. I think what he's done, what a lot of economists have done, is they take a snapshot of a moving picture, and they try to extrapolate from that snapshot. I've been playing around with this chatbot, AI, and it's just an incredible thing that we're going to see, I think, is AI, artificial intelligence, begin replacing white-collar jobs. And I think that this shortage of labor that we have now, not only in the U.S., but you see the same thing in the UK, where they already begun a recession, where they have very low unemployment. Same thing for the Eurozone. I think this is a masking what's going to end up to be a much larger problem, and that's really not enough jobs for people who want to have them. And so I think that this job shortage issue is really just a transitional phase. And you can see this in businesses investing in labor-saving technology. I had a post on my blog a couple of weeks ago about making a T-shirt. It turns out it's kind of a weird idea, but I had followed this for a while because Warren Buffett, Berkshire Hathaway, owned Fruit of the Loom, and they moved jobs to into the Caribbean. And I began doing some work about like how many people it takes to make a T-shirt. And it turns out it takes a dozen, maybe even 24 people to make a T-shirt. All the different hands that have to touch it. Well, this single robot makes a T-shirt by itself.
Wow.
Or you think, well, some jobs might be safe. Like you go to the Starbucks and you get your cappuccino. How can a robot replace that? On my blog, I had a robot barista. And this is the future. And this is going to out. I think we have to, this is the social issue that we're going to have to come to grips with, is what do you do with people, mass numbers of people who don't have to work? There's not enough jobs in the economy. And so I'm concerned that this job shortage, this is a short run sort of technological gap between when the machines replace us, so to speak. So I think that this is so anyways, in the big picture, I think this is why we're going back to this great moderation, low inflation, low growth, and that's going to be the challenge. In the short run, though, what I'm really wrestling with is this idea that the dollar's turned lower, but the pace. I mean, I was looking at the currency that's been the strongest has been the New Zealand dollar. It's up something like 18% in the past 2 months. That is the one I'm watching. I guess like I always like to leave you with a trade idea. That's the one I'm looking for to crack first. That is, if I'm looking for the dollar to correct higher from this fourth quarter, I'd look at Kiwi. And I think the potential I have is maybe down to 60 cents or 61 cents. And today we're trading about 63 3/4. Yeah. So that's the tension I sort of have in my own work right now, is between the idea that the dollar's turned on a fundamental basis after a 2-year amazing trend that left it historically overvalued. And yet on the short term, some of the momentum indicators we use, like the MACDs or the slow stochastics, are still stretched, oversold for the U.S. dollar.
All right. Well, you know, Mark, when those jobs take the Fruit of the Loom, T-shirt makers and baristas, they're going to come over to the FX market because it's so volatile over here, and they're all going to be listening to you. I can almost guarantee it. So, Mark, hey, I want to wish you and your family happy holidays, Merry Christmas, Happy New Year, and I can't wait to catch up with you after the first of the year. Make sure you give Mark a thumbs up. He's struggled through. He's just come off of not feeling 100%, and we just appreciate the fact that you're here with us today, Mark.
Thanks. Good luck to everybody. Have a happy and healthy New Year.
You do the same. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.